York Stock Exchange, CME Group, and the NYMEX. Stephen Guilfoyle, read your early note this morning. You said, really, batten down the hatches, buckle up. It's going to be a tough day, and sure enough, it is. What is at the heart of this? Why are we seeing these falls in the markets?
You can blame this on a number of things. You want to go to commodities, you want to go to global growth and demand, or you just want to say maybe people are losing faith in central banking, which is something we have to deal with now.
But we had a triple-digit move to the upside yesterday, Stephen, so 1 minute they have it and the next they don't.
And it shows you how fragile things are. You saw the moves in Europe overnight. Even though Asia was kind of, sort of, maybe okay, Europe got its tail kicked.
Let's show European indexes because they did get hit pretty hard. Stephen?
Yeah, they sure did. And it's not just because of Volkswagen. And not just because Credit Suisse downgraded all the miners. There's a number of issues facing everybody that deals with China or Asia.
Let me bring in, because you mentioned commodities, I want to bring in Elliott Warren and looking at oil. Oil was down more than 2%. Persistent oversupply worries, persistent concerns about demands. Is there something else? We got a downgraded view of Chinese growth. Again, China seems to be holding our tiger by the tail.
Well, there is an oversupply problem, and it's not going away. In terms of demand is going to be steady. We're so much cheaper than we were even a year ago, right? So people are not going to look at oil and say, well, you know what, I'm not going to heat my house this winter because it's so much less expensive than last year.
Exactly.
But it's a little bit more expensive than it was yesterday or whatever. So, the demand won't go away. In China, perhaps. But here, you're still going to have to take your kid to soccer. You still have to heat your house. Oil and power are much cheaper than they were a year ago. And demand's not going to be the issue, at least not here. There is tons of oil, Liz.
For such a young pup, Elliott, you have such perspective, such wise perspective. Let's throw it to Trent, who may be a few years younger even than you. But Trent, I need to bring this up because I saw it over at our partners, MarketWatch.com, and they said, beware of mutual funds doing tax loss selling that will only exacerbate these big falls. If people are looking for their worst performers and saying this month and next month, sell them off, let's get the tax loss benefits.
I think there definitely could be at least a facet of that at play with what we're seeing, Liz. I think overall it's just more of a risk-off day. We're seeing it here in Chicago in the Treasury markets. The Treasury markets, as of last week through yesterday's session, were trading exclusively on a Fed narrative. So we had the dovish decision last week to keep rates unchanged. We saw the markets rally accordingly. We had a Fed member yesterday talk a little more hawkish. We see it sell off. The reason that today's move is of note to me is because it's largely a hawkish day in every other sector but the Treasuries. We have equities down. We have the dollar index up. We just talked to Elliott. We got crude down. We have gold down. On that Fed narrative, you'd expect the Treasury markets to be down, too. We're not seeing that today. We're seeing that uncertainty creep back in the market, the VIX up, and we have the Treasury markets rallying accordingly. I think it's something you want to pay attention to as we go into next week.
Yeah, we're looking at a 10-year yield now of about 2.13%. It's just a de-risk day. That's it.